We had a pretty decent reversal in the market this week, not in the entire market, but mainly in a lot of sectors that were outperforming. The banks, they've been getting clobbered. Bank of America is down 5.5% on the week. JP Morgan is down 3%. You have a lot of the semis, they were down a lot. AMD was down 11.5% on the week. And you have finally a lot of the tech stocks and the AI stocks. Microsoft is down 4%. You have C3.ai, which was the darling of this, AI rally. It's down 31% in just 5 days. I mean, this is crazy. And you still have a lot of people that actually believe that the market is efficient, that you just can't outperform the market because the market is efficient. I mean, if you think about it, what has changed in 5 days for C3.ai to go down 31%? It's just that some people maybe, or some investors, either they dislike, C3.ai, or they don't like it as much as they used to the week before. And this is how these rallies are driven. This is why they're not sustainable, especially in those AI stocks that don't make a lot of money, mainly because investors get excited about something. Either they get less excited in the future, or they find something else to get excited about. And this whole thing actually reverses, which is why I tell people and my group members to not kind of get, have the feeling of FOMO or get upset whenever you have something like C3.ai. I mean, just skyrocket and it goes up over 200%. Because if you think about it, you would not have bought it on any kind of fundamentals. You would have mainly bought it as a trade to try to bet on a change in sentiment, which is extremely hard to do. And most people, can't actually do it. But I believe the main reason for this whole reversal this week was largely due to Powell reinforcing the likelihood of more rate hikes, because of persistently high inflation. He spoke last week as the market rallied, although it was a pretty hawkish speech, and he said they're going to pause, but they're going to hike 2 more times. And I personally didn't believe him. Most people did not believe him. And this is why the S&P went up. But now maybe the market is starting to believe Powell that maybe he's going to eventually hike 1 or 2 more times because of persistent inflation. And maybe the market is pricing it in. And this what could have caused the decline in a lot of these tech stocks this week. But if you look at this crazy chart, which I personally like it a lot, and this is the difference between the forward EPS estimate and the forward PE ratio of the tech names relative to the S&P 500. So if you look at the black line, and this is mainly the EPS estimate, as you could see, it topped out in July of 2022, and it has been coming down since then because we had very high expectations. So the EPS estimates were coming down as a lot of companies were revising their guidance much lower. Although we did massively beat on estimates the last quarter, but EPS estimates are still much lower than before. Now, if you look on the other hand, this is the multiple of the tech names. So this is the multiple expansion. And as you can see, most of this rally was not actually about any improvement in fundamentals. It was mainly a massive multiple expansion, which is the same level it was at in January of 2022 and much higher than what it was at in 2021. So in my opinion, the market is basically pricing in 0% interest rates for the future. These kind of companies have extremely high multiples, especially like Nvidia, which is why I believe most of the gains in the future are not going to come from a multiple expansion. They're going to have to come from some kind of an EPS improvement and fundamental improvement. And if this disappoints, or if this actually doesn't materialize, then you could have a huge reversal in a lot of these companies. And if you look at the EPS estimate in general, it's still at 221 versus Morgan Stanley's estimates, which they are the most bearish on the street, and it's around 185. This is a massive difference, and I'm not sure what they are using in their EPS estimate. This is a huge difference, and in my opinion, it leaves either a lot of rooms for improvement, but in my opinion, it's mostly gonna be some disappointments over the 221 EPS, not mainly just in 2023, but more going into 2024. And my main thesis around that I have talked about, and some people are starting to talk about it right now, and it's mainly around student loans actually resuming in the United States. They were paused for over 3 years. People took on debt. They bought the Apple phones they couldn't afford. They bought the Apple Watch that they couldn't otherwise afford. They took on credit cards to go on vacation, and all of those things helped the economy a lot. But now student loans are actually resuming, and it's much harder for most people to actually spend less than spend more. I mean, most of us like to spend more, but most people can't just kind of cut on spending, but they're going to have to do it, and it's not going to be pretty for the economy. And Deutsche Bank estimates a resumption of student loan payments will cut consumer spending by over $14 billion per month. I mean, these are a huge number, not just a billion or two, over $14 billion. I mean, this is huge, and I'm not sure if the EPS estimate of the consensus of 221 and 228 for 2024 are actually factoring in student loans. I don't personally think they are. I think Morgan Stanley is factoring in more student loans than they are. After this whole thing came out of, student loans resuming, the EPS used to be 221, and it's still 221 for the consensus, which leads me to believe that they are underestimating the effects of student loans that could actually, have on the economy. And if we look at all of those things that's happening, and we look at the yield curve, which is the 10-year minus the 2-year, but there's a lot of them, and this chart actually shows 10 yield curves. And in a historical basis, when 50% of the yield curves were actually pretty much inverted, when half of them were inverted, the recession was pretty much imminent. We never had, if you look at this red line, we never had over 50% of the yield curves actually invert, and we haven't had a recession. Unless, again, this time is different. But now over 100% of all the yield curves are inverting. And yes, it could be because of inflation. But in my opinion, this is sending a sign that most people are not, paying attention to. And the reason I believe most people are not paying attention to it, what shows me that, is actually where the VIX is trading at. And it's trading at very low levels, in my opinion, around 13.5. I mean, this is very, very low on a historical basis. If you look at the lowest level where the VIX historically trades at, is somewhere around 8 or close to 8.5, and now it's sitting around 13. And if we look at where the VIX actually goes to whenever we have a market crash, every single major market crash has bottomed, it has marked the bottom whenever the VIX hit 40. It happened in the dot-com bubble, it happened in 2008, it happened in 2018, 2019, whenever we had the Fed tightening and the market freaked out. We also had it in March 2020, the market bottomed whenever the VIX hit 40. And this could be the first time ever where, the market bottoms without the VIX hitting 40. I mean, it could be because of the 0-day to expiry options. We didn't have them on such scale before. Some people claim that they are messing up the VIX. It's really hard to tell. But the other things that could be the first time ever, which I'm personally not buying yet, but this is that most of the decline normally happens after the Fed pivots and after the Fed actually starts cutting rates. This is because the market prices in those kind of, rate cuts before they happen, and when they happen, it's nothing really new to the market, and it takes a few months after the decline for the market to actually go up. This is what happened in, the dot-com bubble. We crashed 51% after the Fed pivoted. Same thing in, around, 2000, 2008. We had, the whole thing around the Fed pivot. It crashed 58%. The same thing in March 2020. After the Fed pivoted, we crashed 35%. And now the Fed is pretty close to pivoting. They are at the end of the tightening cycle, and they're going to maybe start cutting rates in 2024. And it's going to be very interesting for us to find out if this time is really different, where most of the decline happened in 2022, and we're not going to have any kind of a bigger decline in the future in late 2023 or maybe in 2024. I am very interested to actually find out, because it has been so accurate, and I just want to find out if this time is actually different, or not. But looking at the S&P's chart is still very, very bullish, which is why I'm not doing any shorts on the S&P 500. I mean, nothing, pretty major. Most of the shorts I had were in January of 2023. And I had to cut them at a loss, and I just, saw the market going up. I just moved on. I wasn't averaging up every day, wanting the market to go down. I just looked at what the market is doing. And most people, I think, they trade the market that they want to have, not the market that they actually have. And it causes, a lot of losses, to a lot of people. But again, the S&P chart is still very, very bullish. I think we will ultimately, retest this trend line. It could be somewhere around 3,800, pretty close to 3,900 actually. I mean, this is the most likely scenario in my opinion, unless we just, do like the DAX, like the German index, and we just go to all-time high. But the most likely scenario in my opinion, we go back, we retest the trend line, and then we could maybe go and make a new all-time high on the S&P 500. But I could be wrong, which is why I'm not betting my life on it. I'm just, I'd like to look at those things to try to figure out if, something could potentially happen, if I should have more cash than usual or less cash than usual. I don't go all in and sell all my stocks because I think the market is going to go down. I never told anyone to do that, and I don't do it myself. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.